All right, I am going to cover analyzing an investment center using profit margin and investment turnover. It's the same concept as return on investment. Okay. We are still measuring the performance using return on investment. However, this formula is just a little bit more sophisticated. Okay. So we can restate return on investment. Remember, we were saying that return on investment was income divided by average assets. Ass. Anyway, uh, we can turn it into profit margin, which is income divided by sales times our investment turnover, our inventory turnover ratio, which is sales divided by average assets. Okay. So here's our data for LCD, and then here's our data for phone. The first formula is profit margin. Okay. So we're taking the 750,000 divided by total sales, and we're saying for LCD, it's 8%. Our profit margin is 8%. Then we can say our asset or our investment turnover, which is sales divided by average assets. So our sales for LCD are 9,375,000 and our average assets is 2.5 million. So we're basically saying that our sales are we're turning them over 3.75 times our assets. And so now we could say, hey, listen, if my margin is 8% and I'm turning that over 3.75%, I think 8 times 3.75% is 30%. Now, if we go back to a previous discussion where we were talking about return on investment and we just did income divided by average assets, our return on investment, 30%. And so all we're doing here is we're just saying it's a more complicated conversation, right? So for the phone, our profit margin is 5% and our asset turnover is 4. And therefore 4 times 5%, 20%. That is our ROI.